Hello students, welcome to another video of Upskilling Commerce series. In this lecture, we will discuss about basics of income tax. Income tax is important because it directly impacts individuals, businesses and the nation as a whole. For individuals, it helps them understand how much of their earnings they are required to contribute to the government and how they can legally save tax through exemptions and deductions. For businesses, income tax compliance builds credibility, ensures smooth financial operations, and avoid penalties. For the government, income tax is one of the largest sources of revenue which is used to fund infrastructure, healthcare, education, defense, and welfare schemes. Students, especially those from commerce background, should learn about this topic early because it not only builds financial awareness but also equips them with practical knowledge that will help them in personal money management, job roles in finance and accounting, and even while assisting their families with tax planning. Now let's discuss about different types of taxes in India. The first one is direct tax. A direct tax is a tax that a person pays straight to the government on their income or wealth, without being able to pass the burden on to anyone else. The most common example is income tax. If you earn a salary, you are personally responsible for paying tax on it. Direct taxes are progressive in nature, meaning the more you earn, the higher your tax liability becomes. In India, types of direct taxes include income tax, which individuals, Hindu undivided families, and firms pay on their annual earnings. Next is corporate tax, which is charged on the profits of companies. Then there is capital gain tax, which applies when someone sells assets like property, gold, or shares at a profit. Another form is the security transaction tax levied on buying and selling securities such as shares in the stock market. In addition, local bodies also collect property tax on real estate. Earlier, India had wealth tax on net assets, but it was abolished in 2015 to simplify the system. Next is indirect tax. An indirect tax is a tax that is collected by an intermediary such as a shopkeeper or service provider from the person who actually bears the cost, which is the consumer. Unlike direct tax, the burden of an indirect tax can be shifted. The best example is GST. When you buy a product, say a mobile phone priced at Rs 10,000, GST at 18% is added, making the bill of 11,800. The shopkeeper collects this extra 1,800 rupees from you and later deposits it with the government. In this way, you are paying the tax indirectly while purchasing goods and services. GST, which has replaced older taxes like VAT, service tax, and excise duty, and is applied on most goods and services purchased. Another major one is customs duty, which is charged on goods imported into or exported out of the country. There is also excise duty, though it now applies only to specific products such as petrol, alcohol, and tobacco, since most items have shifted under GST. In some cases, entertainment tax and other local indirect levies may also apply, but these two are mostly merged under GST. Now let's discuss different types of taxable entities in India. The government has defined different entities under the Income Tax Act because income in society is earned in many different ways and through different structures. An individual may earn from salary or profession, while a family may jointly earn through property or a family business, which is why a HUF is recognized separately. Businesses may be carried out in the form of partnerships, LLPs, or companies, each requiring their own tax treatment since they are legal entities distinct from their owners. Similarly, groups of people may come together as an association of persons or body of individuals to earn income jointly, and even non-human entities like trusts, universities, or DTs are recognized as artificial judicial persons. Local authorities and cooperative societies also earn income through their activities and services. By classifying these various entities as taxable assessees, the government ensures fairness, clarity, and proper regulation while making sure no source of income escapes taxation. Now let's discuss all these taxable entities one by one in brief as per Income Tax Act. The first is an individual. It is the most common type of assessee and refers to a single human being who earns income from salary, business, profession, property, or other sources. Every salaried employee, self-employed professional, or freelancer falls under this category. Next is Hindu Undivided Family, which is popularly known as HUF. It is a unique entity under Indian law consisting of family members descendant from a common ancestor, including their wives and unmarried daughters. It is managed by the eldest member known as the Karta. An HUF is treated as a separate assessee and can earn income and file returns in its own name, which often helps in tax planning. Next is company. It is a legal entity registered under the Companies Act 2013 or under any other previous company law. It can be domestic or foreign. Companies pay corporate tax on their profits and the rates differ from these applied to individuals. Next is AOP, which stands for Association of Persons, and BOI, that stands for Body of Individuals. Association of persons is formed when two or more persons voluntarily come together for a common purpose, often to earn income jointly. Similarly, a body of individuals also represents a group of individuals who join for a purpose, but unlike AOP, only natural persons can form a BOI. For example, if two or more people win a lottery together, the prize money may be taxed in the hands of BOI. Next is artificial judicial person. It refers to entities that are not natural persons but are reorganized by law as having rights and responsibilities. Example includes trusts, universities, and even deities like a temple idol, which can legally own property and earn income. Next is a firm or an LLP. A firm refers to a partnership formed under the Indian Partnership Act where two or more persons come together to do business. An LLP is known as Limited Liability Partnership, which is a modern version of a firm offering partners limited liability like a company but the flexibility of a partnership. Both firms and LLPs are separate assessees under the tax law. Next is local authority. It includes organizations like municipal corporations, panchayats, and other local bodies that perform civic and administrative functions. And the next is cooperative society. It is an association of people who voluntarily unite for a common cause, usually for mutual benefit, such as housing societies or credit cooperatives. These are also recognized as separate assessees under the Income Tax Act. Now let's talk about residential status. Income tax in India does not depend on a person's nationality or citizenship. It depends entirely on their residential status as defined under Section 6 of the Income Tax Act. Residential status is determined by the number of days a person stays in India during a financial year, and this classification decides the scope of income that becomes taxable in India. Based on this stay, an individual can be classified as a resident but not ordinarily resident, and a non-resident, and each category carries a different level of tax liability. A resident is taxed on their global income, which includes income earned in India as well as income earned abroad, such as salary from foreign employment, interest from foreign investments, or rent from property outside India. This is because residents have strong economic and personal ties with India and therefore fall under the full tax scope of the Income Tax Act. A resident but not ordinarily resident has a limited tax liability. RNORs are taxed on income that is earned or received in India and on certain foreign income only if the business or profession generating it is controlled or managed from India. This category generally applies to individuals who have recently returned to India after living abroad or who did not stay in India for long durations. A non-resident is taxed only on income that arises or is received in India, irrespective of the amount of income earned abroad. India does not tax the foreign income of NRIs because they do not have a sufficient economic presence in India. For example, an NRI earning salary in Dubai does not pay tax on that income in India. But if the same NRI earns rent from a property located in India, that rental income becomes taxable here. Residential status is therefore a crucial factor in determining how much income will fall within the Indian tax framework. Two individuals may earn similar incomes, but their tax obligation may differ completely depending on whether they are classified as resident and not ordinarily resident, or non-resident. In essence, this rule ensures that taxation is based on a person's economic connection and presence in India and not on citizenship. Now let's discuss some basic definitions in the Income Tax Act. The first one is previous year. The previous year is the financial year in which the income is earned. In India, the financial year runs from 1st April to 31st March. Whatever income a person earns during this period is known as income of the previous year, and it is taxed in the following year, called the assessment year. Income earned between 1st April 2025 to 31st March 2026, the previous year will be 25-26. The next one is assessment year. The assessment year is the year immediately following the previous year in which the income earned during the previous year is evaluated, assessed and taxed by the Income Tax Department. During the assessment year, taxpayers file their income tax returns, declare their income and pay the applicable taxes. For example, income earned in the previous year 25-26 is assessed in the assessment year 26-27. The next is assessee. An assessee is any person who is liable to pay tax or required to file a return or subject to any proceeding under the Income Tax Act. An assessee may be an individual, HUF, company, firm, AOP or BOI, local authority or any artificial judicial person as discussed earlier. It also includes a person who is assessed for someone else's income, loss or tax liability, or a person against whom any penalty, interest or refund is determined by the Income Tax Department. The next is gross total income. Gross total income refers to the total earnings of a taxpayer from all 5 heads of income before applying any deductions under section 80C to 80U. To arrive at GTI, all incomes are added together and any permissible loss adjustments are made. The resulting amount is called the gross total income. It is an important step in tax computation because only after calculating GTI can a taxpayer claim deductions like 80C, 80D and 80G to arrive at their final total tax income. The next is total income. Total income is the amount on which a taxpayer actually pays income tax. It is calculated by taking the gross total income, which is the total of all income earned from all the sources, and then subtracting all eligible deductions. These deductions may include investments, insurance premiums, medical insurance, education loan interest, donations, and etc. The remaining balance after claiming these deductions is known as total income. This is also called taxable income because it represents the final income on which tax is computed as per the applicable tax slabs. Next is exempt income. Exempt income refers to the type of income that is completely free from tax even though it is earned during the financial year. The Income Tax Act specifies certain incomes that are not included in the total income of a taxpayer, meaning no tax is payable on them. Examples include agriculture income, receipts from HUF, scholarship for education, gratuity and leave encashment within specified limit, public provident fund interest, and dividends up to a certain limit. Although exempt income is not taxed, in many cases it must still be reported while filing the income tax return for disclosure purposes. Exempt incomes provide relief to taxpayers and support specific social, economic or developmental objectives set by the government. Next one is perquisites. They are commonly called perks. They are the additional benefits or facilities that an employee receives from the employer over and above the regular salary or wages. These may be provided in cash or kind and are considered part of salary for tax purposes if they offer a personal benefit to the employee. Examples of perquisites include rent-free accommodation, company car for personal use, free or concessional education for children, free meals, interest-free loans, medical facilities, or payment of utility bills by the employer. Some perquisites are fully taxable, some are partially taxable, and a few are exempt based on specific rules under the Income Tax Act. Perquisites form an important part of the compensation structure and are included while calculating the employee's taxable salary. Next is allowances. Allowances are fixed amount of money paid by an employer to an employee to meet specific expenses related to the job or personal need. They are given in addition to the basic salary and may be fully taxable, partially exempt, or completely exempt depending on the nature of the allowance and the rule under the Income Tax Act. Common examples include house rent allowance for accommodation, dearness allowance to offset inflation, travel or conveyance allowance, children's education allowance, medical allowance, and leave travel allowance. Allowances help employees cover necessary expenses and can also reduce tax liability when exemptions are available, such as HRA exemption or LTA exemption for travel. These allowances form an important part of the salary structure and directly impact taxable income. Next is capital assets. A capital asset refers to any kind of property, movable or immovable, tangible or intangible, that is owned by a person and held for investment or personal use, rather than for regular business trading. It includes assets like land, buildings, houses, vehicles, jewelry, shares, bonds, mutual funds, trademarks, and goodwill. Capital assets are important under the Income Tax Act because any profit earned from selling these assets result in capital gains which are taxable. However, some items are not treated as capital assets, such as stock in trade, personal wearing apparel, agricultural land in rural areas, and certain specified bonds. The classification of an asset as a capital asset determines how tax is calculated when it is sold or transferred. Next is casual income. Casual income refers to income that is unexpected, irregular, and not likely to recur, meaning it is not earned through any planned activity or regular source of earnings. It arises purely by chance or luck. Common examples of casual income include lottery winnings, quiz show prizes, card game winnings, horse race betting, gambling, or any unexpected reward or windfall gain. Under the Income Tax Act, casual income is fully taxable and no expenses or deductions are allowed against it. In most cases, it is taxed at a flat rate of 30% plus surcharge and cess. Since it is unpredictable and not connected to one's profession or business, it is treated separately from normal income. Next is assessment. Assessment refers to the process used by the Income Tax Department to examine, verify, and determine the correct amount of income, deductions, and tax payable by a taxpayer for a particular assessment year. It involves checking the information provided in the income tax return, ensuring that income is correctly reported, and confirming whether the right amount of tax has been paid. Assessment may be done automatically through computerized systems or manually by a tax officer if detailed verification is required. The ultimate aim of assessment is to ensure that taxpayers follow the law correctly, that income is accurately calculated, and that the government receives the proper amount of tax. Next is deductions. Deductions are specific amounts that taxpayers are allowed to subtract from their gross total income to reduce their taxable income and ultimately lower their tax liability. The Income Tax Act provides deductions under Section 80C to 80U, encouraging taxpayers to save, invest, or spend on eligible activities such as life insurance premiums, PPF contributions, tuition fees, health insurance, medical treatment, education loan interest, donations, and disability benefits. These deductions are available only after calculating gross total income and help in minimizing the final tax burden. By claiming permitted deductions, individuals can pay tax only on the remaining income known as total income. Now let's discuss heads of income as per section 14 of the Income Tax Act 1961. First is income from salary. Income from salary refers to the earnings a person receives from an employer in exchange for services rendered under a formal employer-employee relationship. It includes not only the basic salary but also allowances like HRA, DA, travel allowance, and perquisites like rent-free accommodation, company car, etc. and also any other payments received as part of employment. Even if the salary is received in advance, in arrears, or in lieu of leave, it is taxable under this head. The law also provides certain exemptions like HRA and leave travel allowance and a standard deduction to reduce the tax burden on salaried individuals. In short, this head covers all forms of compensation received from an employer, ensuring that employment income is properly taxed. Next is income from house property. Income from house property refers to the income that a person earns by owning a building or land attached to it, such as a house, shop, office, or even a piece of land used for storage. The law taxes this income on the basis of the property's capacity to earn rent, whether the property is actually rented out or could reasonably be expected to earn rent. It includes rental income from letting out property, and even a self-occupied house is considered under this head. From this income, deductions are allowed such as 30% standard deduction for repairs and maintenance and interest on home loan. In short, this head ensures that property ownership and rental income are taxed fairly, while also giving benefits to homeowners. Next is PGBP, known as Profits and Gains from Business and Profession. It is the head under which all income earned through carrying on a business or a professional activity is taxed. Business includes any trade, commerce, or manufacturing activity, while profession covers specialized skills such as doctors, lawyers, architects, chartered accountants, etc. Under this head, the taxpayer is allowed to deduct all expenses that are incurred wholly and exclusively for running the business or profession, such as rent, salary paid to employees, electricity, raw materials, depreciation on assets, etc. from the gross receipts. The balance amount is treated as taxable profit. This head also covers income from speculative business and income of freelancers. In short, it ensures that only the net income, which is after expenses from business and professional work, is taxed, making it fair for entrepreneurs and professionals. Next is capital gains. Capital gains are the profits that arise when a person sells or transfer a capital asset, such as a land, building, shares, mutual funds, gold, or any other investment for a price higher than its purchase cost. The difference between the sale consideration and the purchase cost is treated as capital gain and taxed under this head. Capital gains are divided into two categories. Short-term capital gains, which arises when the asset is sold within a short holding period, and long-term capital gain, which arises when the asset is held for a longer duration. Long-term gains generally enjoy a lower tax rate and also allow certain exemptions if the money is reinvested in specified assets. In short, this head ensures that wealth created from investments or asset transfers is brought under the tax net in a structured manner. And the last is income from other sources. It is the residual head of income under which any earnings that do not fall under the first four heads are taxed. It acts like a catch-all category. Common examples include interest income. It can be from saving account or fixed deposits or even bonds. Dividend income, lottery or game show winnings, gifts received, and rent from vacant land, Certain unusual incomes, such as money received without adequate consideration or compensation received, may also be taxed here. The taxpayer is allowed to claim deductions for expenses directly relating to earning such income. For example, commission paid to a banker for collecting interest or reasonable expenses for maintaining an asset. In short, this head ensures that every form of income, even if irregular or miscellaneous, is properly taxed. Now let's discuss how total income is computed to arrive at the final tax liability. The computation of total income begins with calculating income under each of the 5 heads. These are then aggregated to arrive at the gross total income, and from gross total income, other adjustments are made for clubbing of income and setting off and carrying forward of current year's losses. After that, deductions under Chapter 6A such as ATC, ATD and other deductions are subtracted. The balance is then called the total income, which is rounded off to the nearest 10 as per the Income Tax Act. Finally, tax is computed on this total income as per the applicable slab rates, and surcharge and health and education cess are added to arrive at the final tax liability of the assessee. Now let's discuss different slab rates which are applicable in India as per Income Tax Act 1961. First is the default regime as per Section 115 BAC. As you can see on the screen, up to rupees 3 lakh, 0% tax is to be paid by the assessee, and as the income increases, the tax slab rate keeps on increasing. For the income of 3 lakh to 7 lakh, 5% tax is to be paid by the assessee. From 7 lakh to 10 lakh, it is 10%. From 10 lakh to 12 lakh, it is 15%. From 12 lakh to 15 lakh, the tax percentage is 20%, and above 15 lakh, the percentage of tax is 30%. To calculate income tax for assessment year 25-26 under the new regime, first compute your gross total income by adding salary, house property income, business and profession profits, capital gains and income from other sources. Next, reduce allowable deductions such as the standard deduction for salaried individuals and applicable exemptions. As the new regime offers lower slab rates as compared to the old regime, it disallows most deductions under Chapter 6A. The result is your taxable income on which the mentioned slab rates are applicable. If your taxable income does not exceed 7 lakh, you get a rebate under Section 87A, making your tax liability nil. For higher incomes, surcharge is applicable, which is based on the slab rates, and the income should be above 50 lakh. At last, a 4% health and education cess is levied. From this, we need to subtract TDS or any advance tax which is already paid to arrive at the final tax payable or any refund that is due. Now let's see what is rebate and surcharge. Rebate under Section 87A is a benefit available to resident individuals with lower incomes. It reduces their tax liability effectively, bringing it down to zero if the income is within the specified limits. For the assessment year 25-26 under the default regime, rebate is available for taxable income up to 7 lakh, capped at 25,000. This provision ensures that small taxpayers are fully exempt from paying tax. Talking about surcharge, it is an additional charge levied on the amount of income tax applicable only to high income individuals. For assessment year 25-26, individuals with total income exceeding 50 lakh are required to pay surcharge at increasing rates. If the income is above 50 lakh up to 1 crore, 10% of surcharge is to be levied. If the income is from 1 crore up to 2 crore, 15% of surcharge is to be paid. For incomes between 2 crore up to 5 crore, 25% of surcharge is to be paid. And if the income is above 5 crores, 37% of surcharge has to be paid. However, In the case of certain incomes like capital gains under section 111A and 112A, the maximum surcharge is capped at 15%. Finally, the cess is a compulsory additional levy imposed for a specific purpose. In the case of income tax, the health and education cess is charged at the rate of 4% on the total of income tax plus surcharge. Unlike rebate and surcharge, which apply conditionally, the cess is levied uniformly on all taxpayers to raise funds for education and healthcare needs of the country. The next type of regime is old regime. For individuals and HUFs whose age is below 60 years, up to 2,50,000, there is no tax. From 2,50,000 to 5 lakh, 5% tax is charged. From 5 lakh to 10 lakh, 20% of tax is charged. And above 10 lakh, 30% has to be paid. Talking about senior citizens whose age is between 60 to 80 years, up to 3 lakh, they are not liable to pay tax. From 3 lakh to 5 lakh, 5% has to be paid. From 5 lakh to 10 lakh, 20%, and above 10 lakh, 30% has to be paid. Old regime has another category of super senior citizens whose age is 80 years and above. For such individuals, up to 5 lakh, 0% is to be paid. From 5 lakh to 10 lakh, 20%, and above 10 lakh is 30%. Under the old tax regime, taxpayers can claim a wide range of Chapter 6A deductions such as 80C for investments up to 1,50,000, 80D for medical insurance, 80G for donations, 80TTA or 80TTB for interest income, and many others, which can significantly reduce taxable income. Under this regime, a rebate under Section 87A is also available to resident individuals whose total taxable income does not exceed 5 lakh. This rebate allows a deduction of the entire tax liability up to a maximum of 12,500, effectively making the net tax payable zero for such taxpayers. However, if taxable income exceeds 5 lakh, even by a small amount, the rebate is not available at all, as the application of surcharge and cess is the same as we discussed for the default regime for assessment year 25-26. Now let's see which regime is beneficial for the assessee. An assessee decides between the old and the default tax regime by comparing the total tax liability under each. And under the old regime, all eligible Chapter 6A deductions can be claimed, potentially reducing taxable income significantly. The default regime offers lower slab rates but allows only minimal deductions. Taxpayers should calculate their tax under both regimes, considering their income, investments, and deductions, and choose the one resulting in the lower tax payable. Generally, the old regime is beneficial for those with substantial deductions and investments, while the default regime suits those with fewer deductions who prefer simpler compliance. Now let's talk about income tax return. ITR is a form in which a taxpayer submits details of their income, expenses, deductions, and taxes paid to the Income Tax Department of India for a particular financial year. It is basically a declaration of how much you have earned, from what sources have you earned, and how much tax you have already paid or still you need to pay. If you have paid more tax than required, you can claim a refund through ITR, and if you have paid less, you must pay the balance tax amount. Filing ITR is not only a legal obligation for those whose income crosses the exemption limit, but it also serves as an official proof of income, which is useful when applying for loans, visas, or other financial transactions. Who should file ITR? Well, any person whose income is taxable under the Income Tax Act 1961 is required to file an income tax return. Even if the income is below the limit, filing becomes mandatory if certain conditions are met, such as depositing 1 crore or more in current accounts, incurring foreign travel expenses of 2 lakh or more, paying electricity bills of 1 lakh or more in a year, holding foreign assets or income, or wanting to claim a TDS refund or carry forward losses. Filing ITR is also advisable on a voluntary basis as it serves as a valid proof of income, helps in availing loans, visas, or credit cards, and ensures compliance with the tax department. Due dates and non-filing consequences. The due date of filing an income tax return in India is generally 31st July of the assessment year for individual taxpayers and non-audit cases, while for businesses or individuals requiring audit, it is 31st October, and for those requiring transfer pricing reports, it is 30th November. If you miss the due date, you can file a belated return by 31st December of the assessment year, but this attracts a late filing fee of up to 5,000 along with interest on any unpaid tax. Non-filing of ITR may also lead to loss of benefits such as carrying forward losses, denial of TDS refunds, and can create compliance issues when applying for loans, visas, or during tax scrutiny. In extreme cases, willful non-filing may even attract penalties and prosecution under the Income Tax Act. Now we will discuss about different ITR forms. The ITR forms in India are made and notified every year by the Central Board of Direct Taxes, which functions under the Ministry of Finance and Government of India. CBDT is the apex authority that administers the Income Tax Act 1961. It frames policies, issues circulars or notifications, and prescribes the return forms, that is ITR 1 to ITR 7, depending on the changes in law, tax slabs, exemptions, and compliance requirements for that financial year. Once notified in the official gazette, these forms become applicable for taxpayers to file their income tax returns for the relevant assessment year. Let's discuss them in brief. First is ITR 1, also known as Sahaj. This form is for resident individuals with income up to 50 lakh. It covers income from salary or pension, any one house property, and income from other sources such as interest. It is the simplest form mainly used by salaried individuals with straightforward income sources. However, it cannot be used if you have more than one house property, capital gains, business income, or any foreign income. Next is ITR 2. This form is for individuals and HUFs who do not have income from business or profession. It can be used if you have income from salary, more than one house property, capital gains like sale of shares or property, or foreign assets and income. This form is suitable for people with more complex income sources but who are not self-employed or running a business. Next is ITR 3. This form is meant for individuals and HUFs who have income from business or profession. Along with business income, it also covers salary, house property, capital gains, and other income sources. Professionals such as doctors, lawyers, and consultants, as well as business owners maintaining detailed books of accounts, typically file ITR 3. Next is ITR 4, also called Sugam. This form is for individuals, HUFs, and firms, but except LLPs, who opt for presumptive taxation under sections 44 AD, 44 ADA, or 44 AE. It is applicable when total income does not exceed 50 lakh and income is declared on a presumptive basis, that is, a fixed percentage of turnover or receipts. Small shopkeepers, freelancers, and professionals who want a simplified way to file returns without detailed accounts often use this form. Next is ITR 5. So this form is for entities such as partnership firms, limited liability partnerships, AOPs, BOIs, and cooperative societies. Basically, it covers business entities other than companies and those not required to file ITR 7. Next is ITR 6. This form is applicable for companies except those claiming exemption under Section 11, which applies to income from property held for charitable or religious purposes. It requires detailed disclosure of business income, taxes, and audit reports, making it suitable only for registered companies. And the last is ITR 7. This form is for persons or entities required to furnish returns under specific sections such as 139 4A, 139 4B, 139 4C, or 139 4D. It is typically used by trusts, NGOs, political parties, educational institutions, research bodies, and charitable or religious organizations. Now let's discuss about TDS and TCS. TDS is a system where tax is deducted at the very point when income is generated. Instead of waiting until the end of the year, the person making a payment, such as an employer, bank, or tenant, deducts a small percentage of tax before giving the money to the recipient. For example, an employer deducts TDS from an employee's salary. TDS applies on salary, interest, rent, contractor payments, professional fees, commission, dividends, property sales, goods purchase, winnings, and payments to non-residents. The deducted amount is then deposited with the government on behalf of the taxpayer. Later, while filing the income tax return, this TDS is adjusted against the person's total tax liability, and if extra has been deducted, a refund can be claimed. TDS applies on salary, interest, rent, contractor payments, professional fees, commission, dividends, property, goods purchase, winnings, and payments to non-residents. On the other hand, TCS is a system where tax is collected by the seller at the time of selling certain goods or services. The buyer pays not only the price of the goods but also an additional amount of tax, which the seller then deposits with the government. This usually applies to sale of specified goods that include alcoholic liquor for human consumption, tendu leaves, timber obtained from any mode, forest produce, minerals like coal and iron ore, and scrap. In case of normal goods, if a seller's turnover in the previous financial year exceeds 10 crore, they must collect TCS on the sale value exceeding 50 lakhs from a buyer. This does not apply to import or export. Also applicable on other transactions such as motor vehicles costing more than 10 lakh, sale of overseas tour packages, and some foreign remittances. Just like TDS, the tax collected through TCS also appears in the buyer's Form 26AS and is adjusted against the final tax liability at the time of filing the income tax return. The rates of TDS and TCS are not same for all items and they differ widely. TDS generally ranges from 1% to 30%, while TCS is usually between 0.1% to 5% depending on the nature of the transaction. The main difference between TDS and TCS is in who is responsible for deducting or collecting the tax. In case of TDS, the payer deducts the tax before making payment. And in case of TCS, the seller collects the tax from the buyer at the time of sale. Both systems serve the same purpose of ensuring early and regular tax collection, reducing the risk of tax evasion and making the tax system more efficient. Now let's have a look at advance tax. Advance tax in India is a system where individuals, businesses and companies are required to pay their income tax in installments during the financial year instead of at the end of the year. It applies when the total tax liability is 10,000 or more after considering TDS and rebates. Taxpayers must estimate their income, calculate tax as per slab rates, deduct TDS or TCS and pay the balance in installments. It is to be paid in a financial year. 15% of the advance tax has to be paid up to 15th June, 45% up to 15th September, 75% up to 15th December and 100% up to 15th March. Salaried employees usually don't need to pay unless they have additional income like rent, interest, or capital gains, while businesses and professions must pay regularly. Failure to pay leads to interest under respective sections of the Act. This system ensures taxes are collected in advance, reduces last minute financial burden, and helps maintain compliance with the Income Tax Act. Now, what is income tax refund? An income tax refund is the amount that the income tax department returns to the taxpayer when they have paid more tax than what was actually due for a particular financial year. This excess tax may arise due to higher TDS deductions, advance tax payments, self-assessment tax, or incorrect estimation of taxable income. After the taxpayer files the income tax return and the department processes it, if the system finds that the tax paid exceeds the actual tax liability, the extra amount is refunded directly to the taxpayer's bank account. A refund only arises when taxes paid are more than taxes payable, and it reflects proper compliance and reconciliation of income and deductions. Now let's see what is tax audit. A tax audit under Section 44AB of the Income Tax Act 1961 is an examination of a taxpayer's books of accounts to ensure proper compliance with income tax laws and accurate reporting of income, expenses, and deductions. It is mandatory for businesses with turnover above 1 crore and for professionals like doctors, lawyers, or chartered accountants with gross receipts above 50 lakhs in a year. The audit report filed in Form 3CA or 3CB along with Form 3CD must be submitted by 30th September of the assessment year. Failure to conduct a tax audit attracts a penalty of 0.5% of turnover or up to 1,50,000, whichever is lower. The three main forms that are used under tax audit are Form 3CA, Form 3CB, and Form 3CD. Let's have a look in detail. Form 3CA is applicable when a taxpayer's accounts are already audited under another law, such as the Companies Act 2013, and it refers to that audit report while attaching income tax specific details through Form 3CD. Form 3CB is used when the accounts are not audited under any other law, for example, in case of sole proprietors or professionals, and in this case too, Form 3CD must be attached. Form 3CD is a comprehensive statement containing around 44 clauses that provide detailed particulars of the business or profession, such as nature of activities, loans, deductions, depreciation, TDS and TCS compliance, related party transactions, and stock details. In essence, Form 3CA or 3CB is the audit report, while Form 3CD is the detailed annexure that accompanies them. So to conclude, income tax is a way for all of us to contribute to our country's growth. By learning how returns, deductions, and audits work, we can handle our money better and stay stress-free with compliance. In simple words, paying taxes is not just a duty, it's also a role in building a stronger nation. So that's all for today in income tax. We will meet in another video lecture with a new topic.